Well, it has been a stellar year for the markets. The Nasdaq is up over 14%, the S&P 500 gained over 12%, and the Dow up over 8%. So can this rally continue into 2015? Joining me now from Phoenix is Joe Brusuelas. He's the chief economist at McGladrey. And here in studio, we're joined by Charles Lieberman, chief investment officer at Advisors Capital Management. Gentlemen, great to have you both on the show. Charles, we're going to start off with you. Record year for stocks, hitting record after record after record. Now, billionaire hedge fund manager David Tepper, he thinks this rally has lots more room to go. He's predicting the S&P will gain between 8 and 10% next year. What do you think?
We're probably 5 to 10%, so we're certainly in general agreement. We don't think it's going to be a major year. It's nothing like 2013, which was over 30%. Valuations are more reasonable now. They're actually still cheap relative to interest rates, but we expect interest rates to go up. So that'll hurt valuations some. So we think there's upside, but it'll be in the context of a bit more volatility.
So still a lot of room left in this bull market to go. Well, I want to bring you in, Joe, because the U.S. economy seems so far to have demonstrated that it can thrive, even with the Fed ending QE3, its bond buying program, and it appears that the U.S. remains insulated from the financial struggles surfacing everywhere from Europe and Latin America to China, Japan, and Russia. So, Joe, what explained the U.S. economy's resilience this year?
Well, the animal spirits are starting to stir here in the United States. We've got a very strong domestic manufacturing sector. Pent-up demand for autos is very strong. Our civilian aircraft industry literally has several years of backlogs, suggesting production will be quite strong well through the remainder of this business cycle and the next. And with this significant decline in oil and gasoline prices, I would expect that U.S. households are going to experience upwards of roughly a $150 billion tax cut, with the production sector also seeing an equal increase in terms of its overall savings with respect to the cost of production. So you have the U.S. domestic economy beginning to stir, and I would expect we're going to see that spill over into next year. Now, are we going to continue growing at that 4.6% clip we've seen over the past 2 quarters? No, but I would expect a nice healthy 3% to be about just right for 2015.
All right, well, Charles, many have said that this bull market run has been Fed-fueled. Do you think that the fundamentals are there to keep it going now that QE3 has finished, and prospectively, with what you're saying, that the Fed may be raising rates sooner than we anticipate, or should be at least?
I don't agree at all to the idea that the Fed has stoked this recovery in the stock market.
So the fundamentals are there? The
fundamentals are there. We've seen an enormous rebound in corporate earnings, corporate profits. Price earnings multiples today are roughly around the post-World War II average. And that's with interest rates at near post-World War II lows. So that's why stock valuations are actually quite reasonable at today's levels.
But Charles, wouldn't you say that some of those corporate earnings, they've beat on the top line because costs have been cut? They've beat on the bottom line, rather, because costs have been cut, and not necessarily because there's been an increase in revenue.
There's always cost-cutting efforts going on, and sometimes more than others. But the fact of the matter is we've seen an uptick, a significant uptick in hiring. So to the extent that firms are now hiring, they are trying to add to their ability to service their customers, produce more, provide more services. That suggests that it's not just cost cutting, it's also top line growth.
All right, and Joe, I want to bring you in because the unemployment rate has dropped from 5.8%, has dropped to 5.8% from 6.7%. When the government announces the December jobs data, it looks like the total for 2014 is expected to be just shy of 3 million. That is, in fact, the most job creation since the dot-com era in 1999. Do you think that this job creation momentum can continue?
Well, I think it's going to slow a little bit in December, as it traditionally does, but I would expect to see a nice healthy clip of around 250,000 per month prevail for the most part throughout 2015. And here's the most important part. 2014 really represented a pivot year in terms of the overall labor market. Through 7 of the first 11 months, the creation of high-wage jobs has outpaced the creation of low-wage jobs. And this is an indication that the U.S. economy is really gathering some steam, and I would expect that trend to continue into next year. Now, the unemployment rate is going to fall, and we're starting to see a monthly churn in terms of people leaving their jobs to get better ones at higher pay. Over the last 2 months, at least in the reporting data, 2.7 million people in each month left jobs and got better ones. So as long as that trend continues, we should expect to see people who've been out of the workforce come back in, and I'm expecting to see real wages rise for the first time in a significant way here next year.
Wage increases, that's a big concern. Joe, your top focus is what the ECB does. Explain how a QE-like stimulus package from the ECB, or perhaps lack of one, may impact global markets. Okay,
well, the ECB is, in my estimation, mired in another recession, and of course the southern tier of Europe is in a depression. So with deflation rearing its ugly head in Europe, the ECB has to act quickly to overwhelm the situation. If they do not, I would expect global asset markets to be roiled. But right now it does look, and we're going to get a look next week at the Eurozone CPI data, which should show deflation. I would expect the ECB to deploy roughly the equivalent of 1.25 trillion euros on the table next year. Now, I would disagree a little bit with Charles. I think that at least U.S. equity markets were supported by quantitative easing on the part of the Fed, and I would expect if when the ECB acts, and they act forcefully, some of that's going to spill into global asset markets, including here in the United States, which should redound to the favor of equity investors.
Charles, I'm going to give you the final word here. We've got oil prices cut in half, potential stimulus from the ECB, the Fed potentially having to raise rates. What is your top focus, top concern for 2015?
Well, I actually share one of the concerns that I think Joe has, except I would take it a bit further. The labor market in the U.S. is going to continue to improve at a pretty rapid clip, and the most educated parts of our workforce are already employed. The unemployment rate for highly educated workers is around 3%. So really all we're doing now is hiring the lower fringes, which means that firms are really going to have to pay up to find the labor they need.
All right, so we're going to have to leave it there. Thank you so much, Joe Brusuelas, Chief Economist at McGladrey, and here in studio, Charles Lieberman, Chief Investment Officer at Advisors Capital Management. Thank you, gentlemen.